Financial education explains that borrowing money is a transaction where one party receives funds from another with the agreement to repay the principal amount, often with interest, over a specified period. This process is fundamental to modern economies, facilitating everything from personal consumption to business investment. The terms of a loan, such as the interest rate, repayment schedule, and any associated fees, are typically outlined in a formal agreement between the lender and the borrower. Lenders assess risk by examining a borrower's financial history, income stability, and existing debt obligations. A documented plan for repayment is central to the structure of these agreements. Financial literacy resources often describe the importance of understanding all terms and conditions before entering into any credit arrangement. Historically, borrowing has taken many forms, from informal loans between individuals to complex financial instruments issued by large institutions. The underlying principle remains consistent: the temporary transfer of purchasing power. The cost of this transfer is the interest, which compensates the lender for the risk and the time value of money. Without a clear repayment structure, the nature of the transaction becomes ambiguous. Economists generally describe debt as a liability on a balance sheet. When an individual or entity borrows, their liabilities increase. The corresponding asset is the cash received, but this asset is temporary, as it is earmarked for future repayment. The concept of a budget is often discussed in relation to managing financial obligations. A budget is a financial plan that estimates income and expenses over a certain period. When a new debt is acquired, the repayment amount becomes a new, recurring expense that must be integrated into this plan. Financial documents, such as bank statements and credit reports, provide a historical record of an individual's cash flow and borrowing behavior. These documents are used by institutions to gauge a borrower's capacity to handle new debt. An absence of a plan for how borrowed funds will be repaid can create uncertainty for both the borrower and the lender. Consider the mechanics of an unsecured loan, which is not backed by collateral. In this scenario, the lender's decision is based almost entirely on the borrower's perceived ability and willingness to repay. This perception is built on data, such as credit scores and income verification. A borrowing arrangement without a defined plan for repayment deviates from standard financial practices. The standard practice involves amortization, which is the process of spreading out a loan into a series of fixed payments. Each payment consists of both principal and interest. Over the life of the loan, the principal portion of each payment increases while the interest portion decreases. This systematic reduction of the loan balance is a core component of a repayment plan. Financial education materials frequently emphasize the difference between assets and liabilities. Borrowed funds initially appear as cash, an asset. However, the obligation to repay is a liability of equal or greater value, depending on the interest. When borrowing occurs without a clear strategy for repayment, the liability remains on the financial ledger while the associated cash asset is spent. This can lead to a net negative position, where liabilities exceed assets. The discipline of personal finance involves managing this balance. It's an observational process of tracking inflows and outflows. A loan repayment is a predictable outflow. Without a plan, that outflow can become a source of financial disorganization. The psychological aspect of debt is also a subject of study. The commitment to a repayment plan creates a clear path forward. It provides structure and predictability. When this structure is missing, the debt can be perceived as an undefined and ongoing burden. Financial stress can arise from this lack of clarity. A formal borrowing agreement is designed to create this clarity. It specifies the exact amount of each payment, the due date, and the total number of payments required to satisfy the debt. This information allows the borrower to integrate the debt obligation into their long-term financial planning. It is a tool for organization. In a business context, borrowing is often referred to as leverage. Companies borrow funds to invest in projects that are expected to generate returns higher than the cost of the debt. A detailed business plan and financial forecast are essential. These documents show how the borrowed capital will be deployed and how the resulting revenue will be used to service the debt. The process is analytical and data-driven. A loan without such a plan would be considered a higher risk proposition by most commercial lenders. The principles are similar for individuals. Borrowing for an asset like a house or an education is typically accompanied by a long-term plan that considers future income and expenses. The mortgage or student loan has a defined schedule of payments that the borrower plans to meet. Let's examine the information contained within a standard loan document. It details the principal amount, the annual percentage rate, or APR, the loan term, and the monthly payment. The APR is a crucial piece of information as it represents the total cost of borrowing on an annual basis, including interest and certain fees. A repayment plan is essentially a personal commitment to follow the schedule laid out in this document. Without adherence to this plan, a borrower enters a state of delinquency or default, which carries financial consequences that are also specified in the loan agreement. These consequences can include late fees, penalty interest rates, and negative reporting to credit bureaus. The process of managing multiple debts is often called debt consolidation or management. This involves creating a single, overarching plan to address various obligations. The goal is to simplify payments and have a clear, unified strategy for reducing total debt. This again highlights the central role of planning in the context of borrowing. It is the mechanism by which a borrower maintains control over their financial situation. A lack of planning, by contrast, can lead to a reactive approach, where a borrower is simply responding to payment demands as they arise without a forward-looking strategy. This can make it difficult to make progress on reducing the principal balance of the debt. Financial education often uses the analogy of a roadmap. A financial plan, including a plan for debt repayment, is like a map that guides an individual from their current financial position to a future one. Borrowing without a plan is like starting a journey without a map or a destination. The travel is directionless. The resources, in this case, the borrowed funds, are expended without a clear objective. The principles of accounting require that all transactions be recorded and balanced. A loan is a transaction that creates a liability that must be balanced by future payments. A repayment plan is the schedule for these future payments. It ensures the books are eventually balanced. The concept of interest compounding can also apply to debt. If payments are not made according to a plan, the accrued interest can be added to the principal balance. Future interest is then calculated on this new, larger balance. This is known as negative amortization. It is a situation where the total debt increases over time, even if some payments are being made. A structured repayment plan is designed to prevent this by ensuring that each payment is sufficient to cover the accrued interest and reduce the principal. This is why understanding the terms of a loan is so critical. The borrower needs to know if their payment plan will result in positive amortization, where the loan balance decreases over time. In summary, the act of borrowing is intrinsically linked to the act of planning for repayment. The entire framework of lending and credit is built upon this connection. Loan agreements, amortization schedules, and budgeting practices are all tools designed to facilitate and enforce this planning process. A borrowing event that occurs outside of this framework, without a clear and feasible plan for repayment, represents a significant deviation from established financial principles. It creates an imbalance on the personal or corporate balance sheet and introduces a high degree of uncertainty into an individual's financial future. The management of debt is fundamentally the management of a plan. Without the plan, there is only the debt.